What if I told you that many millionaires and billionaires legally pay far less tax than the average employee? Is it because they're breaking the law? No way. They simply understand the tax code better. In this explainer, we're going to break down the absolute most common legal tax strategies used right here in the United States. Just a quick note before we start, this is strictly for educational purposes and is definitely not financial or legal advice. All right, let's get into it. Here is our roadmap for today. First, we'll cover avoidance versus evasion. Then, starting a business, real estate tax benefits, investing in capital gains, and finally, retirement accounts. All right, Section 1, Avoidance versus Evasion. Before we dive into the specific financial strategies, we really need to establish a hard legal baseline. Back in the 1930s, during a Supreme Court case, Judge Learned Hand completely established the legal credibility of minimizing your taxes. He basically said that anyone may arrange their affairs so that their taxes shall be as low as possible. You have no public duty to pay more than the law demands. So what is the actual difference here? Well, tax avoidance is entirely legal. It means you're utilizing deductions, credits, and incentives that are purposefully written right into the law to reduce your taxes. Tax evasion, on the other hand, totally illegal. That involves hiding income, filing false returns, or committing outright fraud, which is a felony that can literally land you in prison for up to 5 years. So to be crystal clear, everything we're discussing today falls strictly under legal tax planning. Moving right along to Section 2, starting a business. You know how business owners always seem to pay less tax? A massive reason for that is because they get to deduct legitimate operating expenses before paying taxes on their profits. But they have to follow the IRS golden rule. These expenses must be ordinary, meaning they're common in your specific industry, and necessary, meaning they are actually helpful and appropriate for your business. You can't just buy a personal yacht and write it off as a brainstorming vessel. It genuinely has to meet both of those criteria. Just look at the sheer volume of legal write-offs out there. If you own a business, things like office rent, business travel, advertising, software subscriptions, and employee salaries can all be deducted. Even using a specific portion of your home exclusively for business might let you deduct a percentage of your rent and utilities. By legally deducting these costs, business owners drastically lower their taxable income compared to standard employees. Okay, Section 3, Real Estate Tax Backups. Real estate is where things get really fascinating, offering some incredibly powerful benefits. Let's talk about depreciation. See, the IRS recognizes that buildings physically deteriorate over time, right? But the land they sit on doesn't. So, say an investor buys a $5 million property where the land is worth $1 million. They can't depreciate that land, but that $4 million building, they get to write that value off over a set number of years. It's a non-cash deduction that offsets ordinary income, saving massive amounts of money without requiring the investor to spend extra cash out of pocket. But what happens when real estate investors want to sell that property for a massive profit? Usually, bam, you pay tax right then and there. However, savvy investors often use IRC Section 1031. This section allows you to completely postpone or defer paying that capital gains tax as long as you take those proceeds and reinvest them into similar, like-kind properties. Of course, the IRS doesn't just hand this out. They impose some incredibly strict rules. You have to follow a really rigid timeline. After you sell your property, you have exactly 45 days to identify potential replacements in writing. And I mean exactly 45 days. This time limit absolutely cannot be extended for any circumstance, unless there's a presidentially declared disaster. If you miss that incredibly tight window, boom, your entire gain becomes taxable immediately.
All right, Section 4, Investing in Capital Gains.
Here is a real game changer. In the U.S., investment income is treated completely differently by the government than standard wage income. Your salary, taxed at ordinary income rates, which can be pretty steep. But when you invest in assets, you're dealing with capital gains. And the absolute secret sauce here is patience. To unlock those favorable tax rates, you must hold the asset for more than 1 year before selling. This is exactly why wealthy individuals focus so heavily on investing rather than just relying on a paycheck. By holding on to assets, they avoid triggering taxes while their wealth just keeps appreciating. And that patience translates into some serious tax savings. Under the 2025 long-term capital gains rates, depending on your income bracket, you could legally pay 0% on your investment profits. 0! And even the highest earners pay a maximum base rate of just 20%, which is way lower than the top brackets for ordinary income. Holding appreciating investments for the long term is just a massive wealth builder. And that brings us to Section 5, Retirement Savings Accounts. The government actually wants you to save for the long term, so they offer powerful tax advantages to encourage it. Let's compare a traditional IRA and a Roth IRA. With a traditional account, your contributions actually reduce your taxable income today, but you'll have to pay taxes when you take that money out during retirement. A Roth IRA is the flip side. You put in after-tax money today, but your investments grow tax-free, and your qualified withdrawals in retirement totally tax-free. So it's basically a strategic choice. Do you want to save on taxes now or save on taxes later?
So let's bring it all together. Can you legally reduce your taxes in America? Absolutely. The playbook is right there. Owning a business to deduct ordinary expenses, holding your investments for the long haul, utilizing real estate depreciation, and maximizing those retirement accounts. But remember, high-income individuals don't just wing this. They are constantly working with CPAs, tax attorneys, and financial advisors to ensure they legally claim every single deduction while staying strictly compliant with IRS rules. Which brings us to our final thought for today. The tax code isn't just this giant list of penalties, it's really a map of incentives designed to encourage things like business growth, housing development, and long-term saving. So now that you understand the rules of legal tax avoidance, how will you use this educational info to legally optimize your own finances? Thanks so much for joining me in this explainer. Keep learning, and I'll catch you next time.